Hello, ladies and gentlemen. My name is Jesse Colombo, and in this presentation, I'm going to be discussing the U.S. corporate debt bubble that I believe is inflating at the moment. First, a bit about me. I'm an economic analyst and registered investment advisor at Houston-based Clarity Financial, and I write for its web publication, realinvestmentadvice.com. I warned about the 2008 global financial crisis as a university student, which then helped me to build a presence of over 150,000 followers on social media. I also write a column on Forbes.com about dangerous economic bubbles that are developing today and how they will cause another financial crisis. Though the soaring stock market has attracted the most attention, a dangerous bubble has also been forming in U.S. corporate debt. Since 2008, total outstanding non-financial corporate debt has increased by over $2.5 trillion, or 40%. U.S. corporate debt is now at an all-time high of over 45% of GDP, which is even worse than the levels reached during the dot-com and housing bubbles. The past three corporate debt booms resulted in recessions, which are the gray bars on this chart. This time won't be any different, unfortunately. Ultra-low interest rates are the main reason for the U.S. corporate debt bubble. As the chart shows, Moody's AAA-rated corporate bond yields hit record low levels after the 2008 financial crisis, thanks to the actions of the Federal Reserve. In an attempt to jumpstart the economy after the recession, the Fed cut interest rates to record low levels and pumped trillions of dollars worth of liquidity into the financial system and markets via their quantitative easing or QE programs. These programs sent bond prices soaring and yields plummeting. Ultra-low corporate bond yields have encouraged U.S. public corporations to borrow heavily in the bond market after the Great Recession. Corporations have been using their borrowed capital to boost their stock prices via share buybacks, dividend increases, and mergers and acquisitions instead of making the long-term business investments and expansions that were more common in the past. This chart shows how share buybacks and dividends surged after the Great Recession. The low interest rate environment and debt-fueled share buybacks helped the S&P 500 to rise by over 300% from its March 2009 low and more than 80% from its 2007 peak. U.S. corporations are using borrowed money to buy their own shares at very high valuations, which is basically throwing good money after bad. The cyclically adjusted price-to-earnings ratio, or CAPE, shows that the S&P 500 is even more overvalued than it was at major historic peaks, including 1929 before the stock market crash and Great Depression. I believe the corporate debt bubble and related stock market bubble will burst due to rising interest rates, which caused the bubble in the first place. Falling corporate bond prices and higher corporate bond yields will put an end to the stock buyback boom, which will also pop the stock market bubble, creating a downward spiral. Now I'm going to discuss how you can preserve your wealth in the coming crash. We at Clarity Financial LLC, a registered investment advisory firm, specialize in preserving and growing investor wealth in risky times like these. We are based in Houston, Texas, and have over $400 million under management. Please visit myclarityfinancial.com to learn more about us. We are wary of following the overcrowded buy and hold strategy when the market is so overvalued because we believe reversion to the mean is inevitable. But we still use a trend-following investing strategy to make sure we capture upside as this bubble continues to inflate. When we determine that the trend and economic cycle has truly changed, we then shift our clients into highly liquid safe havens that typically rise when risk assets like stocks experience bear markets. Please email me at jesse@myclarityfinancial.com so that we can also discuss preserving and growing your hard-earned wealth. Also, please subscribe to this YouTube channel. I will be producing many more videos like this. And once again, I'm Jesse Colombo. Thank you for watching this presentation.